Confident in the restoration of economic sanity, the Fed began to walk back the extreme rate hikes. Pausing during the recovery of 1984 to ensure inflation did not reappear, the Fed had rates by late 1986 back at levels not seen since 1977. Almost immediately, both consumers and the banking system began to react. The parallel actions in each set off the chain of distortions that would lead to the asset bubbles and the current crisis. Again, conventional wisdom has held that inflation was kept low throughout the 80s and 90s while the economy thrived. Much of the economic growth was centered on consumer spending. As we demonstrated previously, households began to change spending patterns with the high-rate 70s. With interest income robust, in the aggregate, households began to spend far more than they made through working. As short-term interest began to fall dramatically, households not only saved less, they again shifted savings preferences. Corporate bond rates did not fall as rapidly as deposit rates, so households and banks that favored Treasury bonds a few years before began to return to corporate credit. And they also shifted to stocks that were generally cheap and ripe for a sustained bull market. With price assets driving net worth much faster than accumulating par assets could, the decline in savings rate had little effect on overall net worth. In other words, deficit spending was psychologically possible because of the rapid increase in and spread of stock wealth. Within the credit system, banks dealt with that shift in emphasis away from traditional deposit assets through leverage. As the savings preferences changed with the new lower rate regimes, banks went where the money went, stocks. Equity financing for banks began in earnest in 1984, rapidly expanding through 1988 and 1989. Commercial bank funding through equity and net worth growth reached 15% and accounted for almost all marginal funding. For savings and loan institutions, marginal funding came from a rapid increase in the use of repurchase agreements. This would ultimately lead to crisis for the industry as falling rates created risk-seeking behavior. So the buildup of savings after the credit-creating 70s was now unleashed in new ways. The first was the supercharged trend of consumer spending. The second was the leveraging undertaken by the financial system. The third was a new channel for credit buildup, away from inventory and into ownership manipulation, and eventually commercial real estate. This change in credit channeling was the primary reason for the 80s and 90s being characterized as low inflation. Instead of credit flowing into the extra demand for goods and materials that the inventory cycles creates, credit instead flowed into price assets that have much less effect on the demand for goods or employment. None of these changes seems to have been accounted for by the Fed. Instead, it allowed itself to imbibe its own hubris, believing it now had the power to effect mastery of not just inflation, but the entire economy. By 1990, the U.S. economy was on the brink of recession. The Fed had, in its view, successfully navigated a near recession in 1986 solely by the interest rate policy and escaped the crash of '87 without economic damages. So as the savings and loan crisis threatened the economy, the Fed again used its monetary interest rate control to try and stimulate the economy out of that predicament. As we know, the recession was mild by previous standards, but, as we alluded to in the opening, the recovery was uneven, and unemployment took much longer than usual to return. Our contention is that by the 1990 recession, all these distortions had conspired against monetary policy in general, and interest rate policy in particular. Just before the recession, we see that inflation had started to become a problem again. Inventory growth had come back as corporate credit usage shifted away from price assets after the collapse of the junk bond bubble. The Feds responded as expected. by increasing interest rates. This put pressure on the banking system already in crisis. Lending nearly collapsed and the economy faltered. As weakness spread, the Fed completely reversed course and drastically reduced rates to try to stimulate the economy. It was also trying to restore the financial system by reducing the cost of funds for the faltering savings and loan industry. But even after the recession had officially ended, weakness continued. As the weakness persisted, the Fed continued to reduce the interest rates until the beginning of 1993 and kept the low-rate policy into the beginning of 1994. When we analyze rate policy from the perspective of our consumer spending distortion, we begin to see why weakness persisted. The collapse in interest rates after 1989 had a direct effect on consumer spending. The reduction in interest income due to the supposed stimulative rate policy forced households in the aggregate to reduce spending. The trend in consumer spending due to marginal interest income that had begun in 1975 was now threatened by the reversal in interest rates. Spending finally began to grow after 1992, but not because of the low rates. Rather, households radically reduced their savings to allow for increased spending. This was in response to the rapid increase in liquid net worth due to increased participation in stocks. With interest rates at lows not seen since the early 1960s, stocks were relatively cheap and started to really attract household money. On the other side of the economic equation, production remained weak all the way through 1992. Inventory fell off with credit. But, not coincidentally, inventory production turned around when the household savings rate began to fall. The entire recovery after the 1990 recession was weak because interest rates were too low, meaning the Fed's rate policy was the opposite of stimulative. It wasn't until equity values and household net worth took off in 1993 that the economy began to fully recover, pulling production up only after savings were reduced in favor of more spending. Not even corporate credit reacted to the Fed's interest rate policy, but the Fed acted as if it was successful yet again.
There is no other agency of government which can overrule actions that we take.
The financial engineering did not end in 1993. The Fed increased interest rates in 1994 and 95, surprising many, but it had little impact on the economy. Unfortunately, the Fed was given credit for engineering a soft landing, and thus began a decade of near-universal acclaim and unearned superstardom. The economy itself was robust, as consumer inflation remained under control and interest rates steadily declined with it as inventories readjusted to new lows. Driven by individual spending and business innovation, it was the best of times. But beneath the surface, misaligned monetary policy continued to distort the economy. With stocks continuing their bull run, households continued to trade marginal savings for marginal spending. By 1999, households were spending over 20% above non-asset disposable income. But to get there, the savings rate had to fall below 2%, a rate not seen since 1947. Of course, this was only possible for two reasons. First, as we discussed, the growing stock bubble was driving household net worth. With stock assets increasing through price action, there was no need to add to savings balances. Second, with savings diminished, consumers looked to other sources to increase marginal spending. The misaligned rate policy allowed households to begin to really add cheap debt. Prior to the 90s, household savings had been primarily placed in par assets that were readily accessible for spending. But by locking up a majority of net worth in less liquid price assets, consumers needed a usable substitute. Cheap debt offered exactly what consumers needed, the ability to spend funds while at the same time leaving stocks in place to capture continuing price increases. Sitting on a vast pile of savings with stock wealth spreading, the incremental debt was at first not much of a problem. But debt was being added so rapidly that by the end of the decade, it had overwhelmed the savings that had taken households decades to build. At the same time household debt was fostering asset inflation, corporate credit was stoking it directly. Just as with the junk bond bubble, corporations that had been using credit for inventory financing returned to ownership transactions once the need for inventory finances receded. Despite the massive increase in corporate funding through IPOs, the dot-com bubble still exhibited a huge decrease in stock supply through leverage buyouts and stock buybacks. That reduction in supply, plus the upward pressure in prices from the premiums paid in each extraction method, made corporate credit directly inflationary. But since the inflation was occurring in stock prices, the Fed never accounted for it when considering monetary and interest rate policy.